Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, July 18th, 2022. It'll be a quick one. I just wanted to update. I normally wouldn't even have done an update today, and nothing's really changed too much, but there was a nice sell-off today, so I'm going to talk about that a little and then just tell you where we stand. Okay, the news was, as I posted out earlier, since you got you out something else earlier, we had a big drop intraday, 110, well, not 100%, but close to enough, largely attributed to the 800-pound gorilla in the room, Apple. That is by far the largest component of the Nasdaq 100, also largest component S&P 500. So it is the single most important stock as far as the indexes, stock markets go, without a doubt. And so you can see they faded it pretty hard intraday, about a 3% drop by the close, down 3.2 off the highs. That is, this is just an intraday chart. And the news was that they said they plan to slow hiring in certain divisions in 2023 next year. Okay, so that's obviously, everyone looks to big market leader, and takes cues from that. But let's look at the price action here and let's talk about what was good and what was bad today. This is a 60-minute chart. You can see here, and I've covered this quite a bit recently. We had this major primary downtrend line here taken out the other day. That trend line comes from the early April, late March highs, early April highs right there, and you had divergences building right there on the PPO, and you also had oversold conditions there, and that was the bottom. We've been zigzagging higher. If you strip all the lines away, this was just nothing more than a blip right now. As of now, it can certainly morph into more and develop into a much bigger drop, maybe even the end of a bear market rally with new lows to come. I'll show you one thing here in a second that it certainly warrants covering. But let's just take things for what they are right now. This is nothing more than just another pullback and an uptrend series of higher lows right there, and we're still at a higher low and higher highs since Apple and the market bottomed back here just about a month or so ago. Okay, so that's it, and I turn on the lines. These are all lines. I have not added a single line here. These are lines I've had on this chart for a while. This one's created back in the 24th of March, and we have a zone here, and it's nice resistance. So Apple ran into price resistance, major reaction low there, reaction low right there, major reaction high right there, and it had negative divergence just like the Qs did, like I pointed out this morning. And so there may be more, but here's the levels to watch. You have an uptrend line right here. You have obviously quite a bit of price support now. It was former resistance, and again, as of now, it's nothing more than just a pullback within an uptrend, and with volatility being high, the drop today is nothing unusual. You see a comparable drop. There's today's drop right here recently, and they gobbled that up. You had a comparable drop back there and right there, but those got gobbled up. And again, it could be the start of something more, but right now there's zero evidence to say that it is. Other than this is worth noting here. This is the daily chart. I was just on the 60-minute chart. Remember the case that I've been making, bullish case, but not just Apple, but the market as a whole. Positive divergences on the daily chart on just about every market-leading stock and every major index there is. And so, and that's only started to play out. It's been a nice rally so far. Nothing goes straight up forever. Apple's already rallied just in the last month or so about 17% into today's highs. So again, we could have plenty more pullback and not do any damage to the longer term bullish case. The one thing give me pause, and I've talked about it many times over the years, is the 200-day exponential moving average. It's this red line here. You're going to see it better. I'm going to go to a weekly chart and show you it there. It's a key level for Apple. So again, we're on a weekly chart, but a 40-period exponential moving average on a weekly is the same exact average as a 200-day on the daily chart, because there's 5 days in a week. So the 200 days divided by 5 equals 40. That's same level, and it's done just throughout over time a pretty good job. Not perfect. nothing is, but it's done a good job. You can see here there was a bull trend that crossed above it every single back test without fail, and we're talking numerous when you zoom in there said is a bull trend by the pullbacks, and then when it broke you entered a bear trend. So these are all the biggest corrections in bear markets Apple's had when we've been under that, including that bear market from 2015 to 2016, the fourth quarter correction in 2018, even when COVID hit. That was the last time we were under the 200-day slash 40-week moving average. And once you regained it, it tells you the trend's bullish and you buy pullbacks to it, right? So, as I did point out and made the case when I was bearish and short back here, that Apple was the last of the big fangs to crack, the big market leaders, and took out the 200, and that's indicative of a bear market. The $1,000,000 question is it going to be like we had back here in the fourth quarter of 2018, where you recovered it and then back tested and kept going, even in COVID, where it was brief, or is it going to be something more like the last bear market, which I consider to be the last bear market? I've gone over that many times. Back in 2007 to 2009. I'm going to zoom into that one there for you. And you can see right there, we took it out, tried to recover for a few weeks, failed it there, and once you were below it, you were in a bear market. That was 2008 right here. Took it out with conviction, back tested it perfectly. That was a short seller's dream, to recycle back into a short. Did it again, boom, boom, boom. Remember, when you have a primary trend, that line will then act as resistance. Took it back here, and it's not like that was a whipsaw. You've stayed above it, and when you regained it, there was a gain of about 28% from the point it was recovered, and that spanned 6 months. Then you went back below it, so that was a nice trend to trade, and then you were below it again. And I'm sorry, gosh, guys, I'm sorry, that was not 2007, 2009. That was the bear market of 2000. That was when tech melted down, the dot-com bubble. And I'm just so. Point is that you can go back as long as you want. It's just done a bang up job. This was the next bear market that hit 2007 to 03, below it, and then you recovered it, and then boom, 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 stayed above it. Here, I'll just zoom in a little bit more back to where we were. I was trying to get to the last bear market for you. There we go, right there. So you took it out in September of 08, and you were below it, and then you recovered it back in in March of 09, shortly after the market bottom, and it's just done a phenomenal job of support and resistance. So what am I giving you? Is a contrary analysis? No, it's longer term. From a longer term perspective, you have to respect that. So it may be a little, there may be some headwinds here, but I like where the market is right now, and I still think this is a buying op, and I'm going to show you what I would do on the QQQs, depending on, if I had no positions right now at all. So we'll watch that. And remember, it is quite common to see it on an intra-week basis get taken out and then only to fail by the end of the week. But also the most important thing is Apple, along with every other the big tech companies, all the big fangs, Amazon, Meta, they all report right around the same time at the end of this month. So you're probably not going to see any big fireworks. Expect maybe somewhat of a grind for the next few weeks with some nervousness coming up. That'd be the most likely scenario. But again, no big technical changes there other than the rejection off the 200-day and price resistance and and the divergences. So all that, like I said, could give us a little more weakness here in the coming days to weeks. You got the Fed meeting next week, and you got all the big fangs reporting, and then we'll know which way. We'll know if this is just a bear market rally with new lows to come. We'll probably have a good idea with and within a couple weeks here by the end of the month, because you'll have the Fed meeting out of the way, then this monthly meeting, you'll have all the big fangs out of the way. I still favor more upside, even if we go down a little before then. So let's go to QQQ, show you what happened there. Remember, the Qs are, almost a mirror of Apple, and so they got knocked down pretty hard. And so far that divergent high. Remember, this was 1, 2, 3, basically a triple top here at about 296, 297, with the indicators really flat line, slightly making slightly lower lows, at least these last two here. So that is negative divergence. It's not the strongest divergence. I usually like to see their prices making much higher highs like this with the indicators flat or slightly low, Or if you have equal highs like this, 1, 2, 3, typically you want to see steeper divergence on the indicators. So this is almost flat on both, and that's why I think these divergences will get taken out, and I think we'll still go on to hit my next targets up here at 301 and 306. And again, it's a matter of where we go first. All right, so I gave you levels earlier today, right before, before the market opened, or right after, or both actually. Pullback levels that would provide objective long entries, and one of those was a downtrend line and the intersecting 292-ish support level, and fired out a post when we were there. Now we went down and closed below that, so I'm not crazy about that. I also this morning said this whole area below there, down to but not below 285 support, that's price support, and the trend line, which are going to come in together if we get there soon. That means you zigzag down, tomorrow's over here, you shift to the right as time goes on the chart, and that would put the next big support. So you can certainly scale in down there. I'll say, based on everything else I just said in this video, the fact that we have negative divergence on the 60-minute chart, on QQQ, on Apple, a lot of the big leading stocks, you have Apple getting rejected off the first test of the 200-day from below, and since it took it out a while ago, based on all that, my preference would be to hold off if I didn't have any positions, and I'm not adding on this right now. I'd like to see this recovered. Why? Because we're here right now in the after-hour session, 289.55. You're only talking giving up another 1.15% on your entry, and so I think it'd be bullish to regain this. That would be a little whipsaw here. Otherwise, we could work our way down here. And again, everybody's different. You may not have any positions, and maybe you want to be long, or maybe you're short and you want to add to shorts. Well, you could certainly add on this breakdown, and then you might want your stop above here. At the same level where somebody wants to see a bull wants to see this level get retaken and then buy there. And then of course you need to, like I said this morning, nothing's changed. We still need to pop 297 right there to open the door up to 301 and then 305, right? So you can also buy scale down here if that's your thing. Like I said, it's just being that you're so close, one could wait till a recovery back above that level and or a break above 297, or they could scale on down here and then use stops. Again, depends on what you're swinging for. These are just intermediate targets. If that bullish case pans out, Apple's going to regain the 200-day moving average. QQQ, most likely after reaction, no guarantees. If it gets to 305, will ultimately work its way up to the higher targets that I have, which includes the 200-day moving averages for the index itself, the Nasdaq 100 and the S&P 500, those indexes. So that's where we're at. That's what happened today. And again, when you turn off all the lines, let's just do that. Nope, that's not what I meant to do. Turn off all the lines. This is QQQ. This is the bottom we had right here. A couple months, 6 weeks ago, 7 weeks ago, something like that. And we've been just working our way up, zigzagging higher. We failed to break to new highs today. If we can do that, that keeps this downtrend solidly intact, as long as we don't violate these. And it's not a all or none kind of thing, meaning if we go down and we undercut these lows, are we going to do this? Not necessarily. It just doesn't make a clean case for an uptrend. So right now, in a strong uptrend, you want buyers to come in and buy the dip. So if they buy this dip tonight in the futures or tomorrow, or we go down, or they buy it up any point above the recent lows, then that just shows you reinforces that we're in an uptrend and there's more buying pressure than selling pressure. Now there's still a lot of people bearish on this market. There's still a lot of trap longs that didn't want to sell, didn't want to heed the warnings. We're drinking the Kool-Aid back here when the market was at all-time highs, and then they're trapped and they want out. And so you get that in a bear market. You get the trap longs that are just dying to get out because they're feeling the pain, and so they're going to sell rallies, and that's why you never go straight up. I mean, we had a rare explosive move when COVID hit, and that was due almost exclusively to the massive Fed intervention. And that's an unusual bottom. Usually bottoms are more of a process versus a single event like that. So that's it. Told you we'd keep this one short. Nothing else to add. The success or failure, a lot of the other what I call risk-on related trades, such as Bitcoin, Ethereum, Other things like that will hinge largely on whether or not we're going to have some more upside here. And maybe, maybe they do their own thing. As long as the market, I think, holds up here for a while, even if it grinds around, you may see some interest. Bitcoin, like I showed you, the Ethereum, the breakout on Ethereum especially was pretty powerful. That was that ETH chart we had here. This is the 6-month, 3-hour candles. This is that basing pattern I was highlighting right here. Beautiful, well-defined, just boom, 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 bouncing between these levels. It broke out, gapped out above it today, and never looked back. Those are the most impulsive kind of breakouts because they deny, objective entries. So longs are waiting for the breakout but didn't want to position ahead, and then it never looks back. It's got a gap right there that it almost filled today. And then, of course, this is still my near-term targets, 1719, and then the trend line which comes into play here, something like that. Or the market's seen its, it took its last up move today, and we go down. That's not my preferred scenario. And if so, this breakout fails, and then the bear market in crypto continues. There's a lot of things going on too with the cryptos right now, with all the big crypto brokers that have failed recently and everything like that. So like always, never put too much money into cryptos. You don't need to put a lot if right. If I'm right, this rally's got plenty more meat on the bone, and it doesn't take a lot of money when you're looking at a 30% gain in a matter of just weeks is what we're looking at here, maybe even days. That's it. Let me wrap it up here. We'll pick it up tomorrow. Everything else is pretty much status quo from what I covered today. All right, this has been Randy Finney with Right Side of the Chart. Have a good one.